if you break your arm, you go to the hospital, right?
Right, yeah.
And the X-ray shows the crack. It's totally binary, like the bone is whole or it's in pieces.
Exactly. It's undeniable physical evidence.
But, I mean, what happens when you step into the world of corporate finance and that diagnostic X-ray is suddenly pointing at, well, a ghost?
Oh, man, that is the perfect way to put it.
Right. What happens when a business is legally mandated to report this massive, devastating financial damage that hasn't even, fully materialized yet?
Yeah, the cash hasn't moved, but the bleeding has started.
Exactly. Welcome to a brand new episode of the Gap Advisors and East Clinic podcast. I'm so glad you're joining us today because we are taking a deep dive into a corporate nightmare that tests the very limits of how businesses are forced to predict, measure, and confess their own looming failures.
It really is the ultimate diagnostic gray area because we are looking at a situation today where the cash hasn't left the bank account, the delivery truck hasn't even arrived, and yet the accounting standards are just standing there with a stopwatch.
Just demanding that the company record the casualty.
Exactly, demanding immediate recognition.
And for you listening, this isn't just some theoretical musing. The source material for today's deep dive is based on a highly specific, real-world dilemma, and it's sourced directly from the issue repository on gapadvisors.com.
Which, by the way, if you are in the trenches of corporate finance, that repository is just an absolute goldmine.
Oh, 100%. It currently hosts over 4,500 specific issues, and their incredibly detailed responses regarding NAS and Indian GAAP.
Yeah, and the best part is literally anyone can register for free, right? You just submit your own complex application issues and get a highly detailed response delivered straight to your inbox.
Right to the email you registered with. It is particularly vital for auditors.
Oh, absolutely. I mean, when you're an auditor staring down a CFO who really doesn't want to record a loss.
You never want to record the loss.
Never. You need ironclad documentation on exactly how you arrived at your conclusion based on the framework. So having that kind of specific issue-based repository to back up how you addressed an IND-AS application issue is just critical for your audit opinion.
Exactly. And the specific case study we're ripping apart today was actually featured in the 204th edition of the Gap Advisors Task Weekly newsletter.
That's a great newsletter.
It really is.
Yeah.
It's authored by C.A. Manish C. Iyer, who is the director at Gap Advisors, and it's published directly on LinkedIn.
And they've put out, what, over 230 editions to date?
Over 230, yeah. So if you are registered on LinkedIn, do yourself a favor and subscribe to that newsletter for free. It's a total no-brainer.
Absolutely.
Now, before we unleash the details of this specific corporate ghost story, we do have a few strict ground rules to establish for the framework of this conversation.
We do, yeah. And we also need to issue a very clear disclaimer right up front.
Right, the legal stuff.
Yep. The views expressed in this deep dive and within the source material we are referencing today are the personal views of the author and are absolutely not binding on the audience.
So don't just take this as gospel and run to your CFO.
Exactly. We are here to dissect the theory, the standard-setting logic, and the practical application. But you, the listener, are strongly requested to seek the help of a professional expert before taking or refraining from taking any action based on the views discussed here today.
Because every single business context has its own unique gravity, right? Expert consultation is pretty much non-negotiable.
Precisely. You can't just copy-paste accounting advice.
No, definitely not. Also, speaking of experts, you can actually book a one-on-one consultation regarding your specific issues on IND-AS and IFRS directly with the author. He has a page on topmate.io, so that's an incredible resource if you need personalized help.
Oh, that's fantastic. Yeah, highly recommend that.
Okay, so let's lay out the parameters of the playing field for our scenario today. First, the functional and presentation currency of the entities we are talking about is strictly the Indian rupee, the INR.
Right, that is our baseline.
Meaning any currency other than the functional currency, the INR, would be treated as a foreign currency.
And that would trigger a whole cascade of exchange rate logic that we are just deliberately keeping off the table today to keep things focused.
Exactly. Second, the reporting period we are trapped within runs strictly from the 1st of April to the 31st of March.
Okay, got it. And third, which is arguably the most expansive point here, while the response we are analyzing is given under the IND-AS framework, there is zero difference between IND-AS and IFRS for this specific topic.
None at all.
None. So, if you are listening to this in London or Toronto or Sydney and your entity follows the IFRS framework globally, the mechanics of this discussion apply perfectly to your balance sheet as well.
I love that. It makes this so universally applicable. Now, I do think a lot of investors, even institutional ones, they just look at the bottom line net profit, right? They look at the revenue growth and they call it a day.
Oh, all the time.
So why should any person who is simply investing their hard-earned money in the shares of a listed company care about the microscopic, sort of arcane rules of accounting standards? I mean, if a company made cash, they made cash, right? What exactly are they missing in the translation if they ignore these standards?
Well, they are missing the hidden time bombs. That's what it boils down to.
Time bombs.
Yeah, because the bottom line of a profit and loss statement is basically an illusion if you don't understand the rules used to calculate it. Accounting standards don't just record history, they actually dictate the reality that management is allowed to present to you.
The legal reality, basically.
Right. Without strict, unyielding standards, a CEO could easily just sweep massive, guaranteed future losses right under the rug.
Just hide them completely.
Totally. They could make a company look wildly profitable on March 31st, cash their massive performance bonuses, and then leave you, the retail investor, holding the bag when those hidden liabilities finally detonate 6 months later.
Wow, so it's really a defense mechanism.
Exactly. Understanding these standards is the only way an investor can look at a balance sheet and know for sure they aren't being lied to by omission.
Okay, let's unpack this because that brings us right to the factory floor of a company we are going to call Sun Limited. So let's look at the facts on the ground.
Okay, set the scene.
So Sun Limited is running its standard operations, and management decides they need a highly specific piece of machinery.
Right. Normal CapEx stuff.
Exactly. So they go out and enter into a binding legal agreement to purchase a custom-made machine from a vendor who we'll call Moon Limited.
Okay, Sun and Moon, I like it.
Keep it simple, right?
Mm.
And the fixed, agreed-upon price for this asset is 4 lakh rupees.
A completely ordinary transaction on the surface.
Well,
A capital expenditure is planned, a vendor is selected, a contract is signed. So Sun Limited is now legally obligated to pay 4 lakh rupees, and Moon Limited is legally obligated to build and deliver this highly specialized equipment.
right. But the timeline is where the trap snaps shut.
Uh-oh.
Yeah. We are approaching the end of the 2017-18 reporting period. It's late March. The finance team is getting ready to close the books on the 31st of March. And suddenly, right at the executive level, Sun Limited executes a complete strategic pivot.
Oh, wow. A complete pivot right at year end.
Exactly. They entirely changed their method of production.
And, you have to understand the chaos this causes downstream. A strategic pivot means the old way of doing things is dead. But the machine they ordered from Moon Limited, it hasn't arrived yet.
Right. It might still be sitting on the loading dock over at Moon Limited's facility.
Or it's on a truck somewhere.
Yeah. And here is the brutal reality of that pivot. Because the production method is now entirely different. That custom machine they ordered is utterly useless to Sun Limited.
It is obsolete before the power cord is ever plugged in.
Yes.
Yeah.
Furthermore, and the source material from Gap Advisors is incredibly specific about this, because it was custom engineered for a now abandoned production line. It cannot be repurposed.
They can't use it for anything else.
No. And it cannot be resold. It will literally be scrapped the exact moment it arrives.
Yeah.
And the expected scrap value is mathematically zero, nil.
So the utility of the asset has just evaporated, but the legal obligation to pay for it remains completely intact.
Exactly. Like, to visualize this, imagine ordering a wildly expensive custom-tailored tuxedo for a very specific, highly exclusive gala.
Okay, I'm picturing it.
The tailor takes your unique measurements, you sign the purchase agreement, they start cutting the fabric.
Yeah.
But 3 days before you're supposed to pick it up, the gala is permanently canceled.
Oh, that's painful.
Right. You are legally bound by contract to pay the tailor for the suit. But you can't wear it anywhere else because it's cut for a specific weird theme, and you certainly can't sell it to anyone else because it's tailored to your exact, slightly asymmetrical shoulder measurement.
Right, right.
You are going to pay top dollar for a garment that is going straight into the incinerator.
That is the perfect analogy because it isolates the core problem here. You have a guaranteed outflow of cash for an asset that possesses absolutely zero economic benefit.
So, we have our core query, our dilemma. Given that the machine hasn't actually been delivered and the cash hasn't technically changed hands yet.
Right, the execution hasn't finished.
Exactly. Should Sun Limited recognize any liability for this looming disaster in the current 2017-18 financial year? And if we do force them to report it, what is the exact amount and what is the precise accounting treatment required?
Well, to solve this, we really have to strip the emotion and the business strategy out of it and just look at the legal and accounting baseline.
Okay, back to the rule book.
Exactly. Before the strategic pivot happened, what exactly was the nature of the relationship between Sun Limited and Moon Limited? Under IND AS 37, which is the standard dealing with provisions, contingent liabilities, and contingent assets, we have to look at how the framework actually defines their contract.
And the rule book points us directly toward the concept of a executory contract, right?
Okay.
Paragraph 3, I believe.
Yes, exactly. Paragraph 3. The framework defines an executory contract as an agreement where neither party has performed any of their obligations or both parties have partially performed their obligations to an equal extent.
Hold on. I want to challenge the logic here for a second.
Go for it.
A standard purchase order fits that definition perfectly, right? Sun Limited ordered the machine but hasn't paid. Moon Limited accepted the order but hasn't delivered.
Correct. Equal non-performance.
But if I sign a legally binding contract to buy 4 lakh rupees worth of equipment, I owe that money.
Legally, yes.
So why on earth does the standard traditionally allow a company to just leave that completely off the balance sheet? Isn't that technically hiding a massive future liability from the investor?
You know, it's a brilliant question, and it goes straight to the philosophical heart of standard setting. You have to look at the macroeconomic impact of what you're suggesting.
Okay, what do you mean?
Well, if the accounting standards forced a company to recognize a hard liability on its balance sheet every single time it issued a routine purchase order, for raw materials, for future consulting services, for next year's office supplies, the balance sheet would become completely unreadable.
Oh, I see. The signal-to-noise ratio would be totally destroyed.
Exactly. The balance sheet would just bloat with hypothetical future actions, masking the actual current financial position of the company. It would make them look incredibly heavily leveraged when, in reality, they are just conducting normal future planning.
Right, they're just running a business.
Well, yeah. So standard setters had to draw a line in the sand. They establish a general rule: you do not record a liability merely upon the signing of an executory contract. You wait until the actual economic event occurs.
Which usually means delivery.
Usually, yes. When the goods cross the threshold of your loading dock and control is transferred, that is the moment the abstract promise materializes into a concrete asset and a concrete liability. Therefore, IND AS 37 explicitly states that it generally does not apply to executory contracts. They just sort of exist in a state of suspended accounting animation.
But standard setters are paranoid, and rightfully so. They know that if they leave a blanket exemption like that, companies will absolutely find a way to weaponize it.
Oh, without a doubt.
So they built in a failsafe.
Yeah.
The standard says it does not apply to executory contracts unless they are onerous.
And that single word is the pivot point for this entire deep dive.
Onerous. Such a heavy word.
It is, and it's the mechanism that prevents the off-balance sheet hiding of guaranteed losses. The moment an executory contract crosses the threshold into becoming onerous, the protective shield of being a simple purchase order just vanishes, and IND AS 37 drags it forcefully onto the balance sheet.
Okay, so if I'm the auditor,
Yeah.
right, and I'm sitting across from the CFO of Sun Limited on March 30th.
A fun meeting, I'm sure.
Yeah, lots of tension.
Right.
And the CFO's arguing, hey, it's just an executory contract. The machine isn't here. We don't have to report this 4 lakh rupee loss this year. I have to prove that the contract has crossed that specific threshold. I have to prove it is onerous.
You do.
How does the standard actually define that threshold? How do I win that argument?
Well, you look at paragraph 10. The rule book essentially asks you to weigh two competing forces on a scale.
Okay, a scale.
On one side of the scale, you place the unavoidable costs of meeting the obligations under the contract. On the other side of the scale, you place the economic benefits you expect to receive from that contract. When the unavoidable costs exceed the expected economic benefits, the contract is officially declared onerous.
It's a pretty brutal, unforgiving equation.
It's very binary.
Let's look at the benefit side of the scale for Sun Limited. The CFO might argue that the machine has value simply because it's a piece of heavy machinery, right?
Yeah, we'll try that.
But the auditor looks at the reality of the strategic pivot. The custom lathe, or whatever it is, has no place in the newly designed factory. It physically cannot produce the new product line.
And you have to look really closely at the concept of expected economic benefits.
Right.
It's not about what the asset could theoretically do in a vacuum, It's about what it can do for this specific entity in its current operational state. Since Sun Limited abandoned the old production method, the operational benefit to them is exactly zero.
And the source material removes any lingering doubt by explicitly stating the expected scrap value is nil.
Right, zero.
This is so crucial because management will almost always try to argue some kind of residual value to avoid the onerous classification.
Oh, yeah, they'll say, well, we can strip it for copper wiring or sell the servo motors to a competitor.
Exactly. But the facts of our specific case today dictate that it is a complete write-off. The future economic benefit is mathematically zero.
So now you look at the other side of the scale, the unavoidable costs. Sun Limited is trapped in a binding legal agreement. They cannot unilaterally cancel the contract without severe financial consequences. Contract law dictates performance, so they owe Moon Limited 4 lakh rupees.
So the scale tips violently. The costs are a guaranteed 4 lakh rupee cash outflow. The benefits are a guaranteed zero. The unavoidable costs massively exceed the expected economic benefits.
The inescapable conclusion is that this agreement has mutated. It is no longer a harmless executory contract just floating in the background of the business. It is a highly toxic, onerous contract.
And this goes right back to our retail investor looking at the bottom line. If the management of Sun Limited wins this argument, if they successfully hide behind a delivery truck hasn't arrived, excuse and defer this to the next financial year starting in April, what happens to the investor reading the March 31st financials?
The investor is being actively misled. I mean, if that loss isn't recorded, the profits for the year ending March 31st are artificially inflated by 4 lakh rupees.
It's a total fiction.
It is. Management is presenting a picture of financial health that simply does not exist. The company has already legally committed to a total loss of that capital. The wealth has effectively been destroyed by the strategic pivot decision made this year.
In the 2017-18 year.
Right. Deferring the recognition of that destruction until the cash actually clears the bank next year is a massive violation of the core matching principle in accounting. You must match the economic reality of the loss with the period in which the event causing the loss actually occurred.
Okay, so the auditor wins the fight. We've diagnosed the fire. The contract is onerous. And NDS 37 demands that it be recognized and measured as a provision immediately.
Under paragraph 66, yes.
But, identifying a fire isn't the same as measuring the ash. If we are forced to put a hard, auditable number on this ghost asset today, what on earth is the ruler we use? How do you measure a transaction that is currently just a piece of paper and a canceled factory plan?
Well, this is where the standard setters really had to earn their paychecks. They had to create a measurement framework that reflects commercial reality, not just pure accounting theory. Paragraph 68 dictates that the unavoidable costs under an onerous contract must reflect the least net cost of exiting from the contract.
The least net cost of exiting. I actually love the grim pragmatism of that phrasing.
It's very realistic.
Yeah, the accounting standards are basically assuming that corporate management, when faced with a massive disaster, will act rationally to stop the bleeding in the most efficient, cost-effective way possible. They won't just blindly walk into maximum damage.
Precisely. And to ensure that the measurement is objective, the standard forces management to evaluate 2 very distinct paths of exit, calculate the cost of both, and choose the lower of the 2 numbers.
Okay, what are the 2 paths?
Path 1 is the cost of simply fulfilling the contract.
Just taking your medicine.
Yes. You pay the full invoice, you take delivery of the machine, and you let it sit in the parking lot and rust. The cost of fulfilling the contract for Sun Limited is straightforward. It's the 4 lakh rupee purchase price.
Okay, so what is path 2? Because path 1 seems pretty bad. I'd want another option.
Path 2 asks you to calculate any compensation or penalties that would arise from a failure to fulfill the contract.
Oh, okay.
In other words, what is the exact cost of deliberately breaching the agreement? If Sun Limited calls Moon Limited and says, we aren't taking delivery and we aren't paying, Moon Limited is obviously going to initiate legal action for breach of contract. Path 2 requires you to estimate the cost of those penalties.
And here's where the source material from the Gap Advisors newsletter presents a fascinating real-world constraint, because the querist who submitted this issue only provided one number, the 4 lakh rupee cost of the machine.
Right, just the purchase price.
They didn't attach a 50-page legal contract detailing the liquidated damages clauses or the specific penalties for cancellation. So how can we possibly calculate path 2 without knowing the legal penalty for breach? I mean, are we just guessing?
Well, this happens constantly in practice. You rarely have perfect, crystalline information, but you cannot simply throw your hands up and say the standard is impossible to apply. You have to use professional judgment based on the nature of the transaction.
And what was the judgment here?
The brilliance of the Gap advisor's response lies in how they deduced the penalty based entirely on the phrase custom-made machine.
Walk me through that legal deduction. Why wouldn't Sun Limited just breach the contract and offer to pay, say, a 10% cancellation fee? Why wouldn't they fight it in court to reduce the damage?
It all comes down to the legal concept of mitigation of damages. If Sun Limited had ordered a standard mass-produced forklift for 4 lakh rupees and breached the contract, Moon Limited has a legal duty to mitigate their loss.
Right, they can't just sue for the whole thing if they can easily sell it to someone else.
Exactly. They could simply take that standard forklift and sell it to the next customer in line. Perhaps they charge Sun Limited a 20,000 rupee restocking or delay penalty. In that scenario, the penalty of 20,000 is drastically lower than the fulfillment cost of 4 lakh.
So the least net cost of exiting would only be 20,000, and that is the amount of the provision you would record.
Exactly, because the vendor isn't entirely destroyed by the breach. They just suffered an inconvenience.
But a custom-made machine is a totally different beast.
Entirely different, engineered for a highly specific, now abandoned production process. If Sun Limited breaches the contract and refuses to pay, Moon Limited is left holding an asset with literally zero market value.
Because nobody else wants Sun Limited's weird, specific machine.
Right. They cannot sell it to anyone else to mitigate their damages. They have incurred the full cost of manufacturing something that only had value to Sun Limited. Therefore, in a court of law, Moon Limited would sue for specific performance or full compensatory damages, demanding the entire contract value.
Wow. So the safest, most legally sound, and most auditor-approved assumption, especially in the absence of a specific clause stating otherwise, is that the penalty for breaching a fully custom contract is equal to the full value of the contract itself.
Yes. The assumed penalty cost is 4 lakh rupees.
So the math is agonizingly stark.
It really is.
Path 1, fulfillment cost is 4 lakh rupees. Path 2, penalty cost for breach is heavily assumed to be 4 lakh rupees. No matter which door the CFO of Sun Limited chooses to walk through, they are walking into a 4 lakh rupee buzzsaw.
The least net cost of exiting is firmly, unavoidably 4 lakh rupees.
Man, the standard has successfully dragged the reality of the situation completely out of the shadows. We moved from an unrecorded purchase order, recognized the evaporation of utility, tested the threshold of the onerous definition, and finally arrived at a precise, inescapable measurement of the financial obligation.
It's beautiful in its strictness, honestly.
It is. We've done the forensic work. We have the theory, the classification, and the math. Now we have to translate this entire corporate tragedy into the actual language of business, the journal entry.
Right, get it on the books.
The Gap advisor's response provides the exact accounting entry required to document this, and it is elegantly brutal.
It really is. The entry requires a debit to the onerous contract provision expenses, account for 4 lakh rupees, and a corresponding credit to the provision for onerous contract liability, account for 4 lakh rupees.
Now, I don't want us to sit here and explain the basic mechanics of double entry bookkeeping. Our listeners understand debits and credits.
Yeah.
What I want to focus on is the sheer violence that this specific entry does to the financial statements on March 31st.
The impact is profound. That 4 lakh rupee debit hits the profit and loss statement immediately as an expense.
Instantly.
Instantly. Think about the gravity of that. The delivery truck is still miles away. The invoice hasn't even been stamped approved for payment by accounts payable. No cash has actually left the corporate treasury.
Right.
Yet because of the strategic pivot, the current year's profits are irrevocably slashed by 4 lakh rupees. Management is forced to eat the financial consequences of their decision in the exact same reporting period that they made the decision.
It completely strips away the illusion of timing. They can't hide behind the calendar, hoping to deal with it next year. And what about the credit side?
Well, the credit to the provision for onerous contract liability account drops a hard liability right onto the balance sheet. It sits there right alongside the bank loans and the accounts payable as a flashing neon warning light to anyone reading the financials.
It's a huge red flag.
It tells the banks assessing debt covenants, it tells the suppliers evaluating credit lines, and it tells you, the retail investor.
There is a guaranteed 4 lakh rupee cash outflow looming on the horizon, and this company will receive absolutely zero economic benefit when that cash finally leaves the building.
That is exactly what it broadcasts.
It's just brilliant. When you really pull it apart, Ind AS 37 acts as a mechanism of absolute financial truth. It prevents the manipulation of reality through the delay of paperwork. It forces transparency and protects the investor by recognizing the loss, the very millisecond the contract transitions from a standard business tool into a guaranteed burden.
It's the ultimate enforcement of the matching principle. If the event causing the loss, the change in production method, happens in 2017-18, the financial pain must be recorded in 2017-18, period.
But, dissecting this single custom machine makes me wonder about the terrifying scale of this issue in the broader economy.
Oh, macro level. It's huge.
Yeah, because we just looked at a relatively isolated 4 lakh rupee problem. But think about the macro implications today.
It's a staggering thought experiment, honestly. We live in an era of hyper-accelerated technological disruption. Entire software ecosystems, cloud infrastructure platforms, and automated manufacturing processes become obsolete almost overnight.
Right. Like a new artificial intelligence model is released to the public, and suddenly a massive, multi-year, multi-million-dollar enterprise software contract you signed 3 months ago is totally useless because the new AI can do it for free.
Exactly. And the standard forces companies to look into the future and price that obsolescence into today's earnings.
But realistically, how many major publicly traded multinational corporations currently have hidden, perfectly normal-looking executory contracts buried deep in their legal departments that are actually highly toxic, onerous contracts in disguise?
Probably more than we want to know.
Right. How many billions of dollars in multi-year software licenses, custom manufacturing dies in overseas factories, or long-term leases for commercial office spaces that are now permanently empty due to remote work?
Yeah, commercial real estate is a huge one.
How many of those are just sitting there waiting to be correctly audited under Ind AS 37 and waiting to absolutely decimate next quarter's earnings?
It is a terrifying prospect for the uneducated investor, but it highlights exactly why understanding these accounting mechanics is your only true defense. The ghosts on the balance sheet are real, and unless you know how to read the X-ray, you won't see them until they've already destroyed your portfolio.
Well, we have certainly covered a massive amount of theoretical and practical ground today. I want to sincerely thank you, the listener, for dedicating your time to this deep dive with us. Navigating the depths of these standards is complex, but it is absolutely crucial for a true, unvarnished understanding of corporate health.
It has been a fantastic exploration of the framework. And remember, the core logic here applies whether you are under Ind AS or IFRS.
Now, before we officially sign off, I do have a few quick requests for you. If you found this breakdown valuable, if it changed how you look at a balance sheet, I highly request that you follow or subscribe to the Gap Advisors Ind AS Clinic podcasts.
Yes, please do.
We are available on Spotify, Amazon Music, and YouTube, whichever platform you prefer to use to listen to Gap Advisors Ind AS Clinic podcasts. Make sure you hit that subscribe button.
And if you want to stay even closer to the pulse of these critical regulatory updates, I strongly urge you to follow the DAP Advisors Ind AS Clinic channel on WhatsApp.
Oh, that's a great resource.
It really is the most efficient way to get instant alerts on all new videos, podcasts, newsletters, newly responded issues from the gapadvisors.com repository, and crucially, any new standard issuances or amendments from the regulatory bodies.
Absolutely. Furthermore, I want to ask a huge favor of you. Please, share this deep dive. Share it among your professional contacts, your colleagues, your audit teams, and your finance departments.
Spread the knowledge.
Exactly. And I want to make a very special plea. Share this with any students you know who are currently pursuing their CA course. Spreading accurate, highly practical knowledge on the real-world application of Indian accounting standards is the core mission here. It elevates the profession and builds a stronger financial ecosystem.
And one final highly actionable resource before we go. If today's deep dive sparked a specific question about your own corporate environment, or if you are staring at your own contracts wondering if they have crossed that dangerous, onerous threshold, you don't have to navigate it alone.
You could book a one-on-one consultation, right?
Yes. To discuss your highly specific Ind AS and IFRS issues directly with the author of today's source material, you can book him straight from his page on topmate.io. Getting an expert to help you read your specific corporate X-ray is invaluable.
It truly is. Because whether it's a fractured bone or a fractured balance sheet, you cannot treat what you refuse to correctly diagnose. Thank you once again for joining us, and we will catch you on the next deep dive.